Now it's my pleasure to introduce our panelist for today's broadcast, Lee Sheehan. Lee leads the provision of all tax services delivered by Radius. He has over 20 years of experience advising companies on a broad range of tax compliance and planning matters. As a chartered tax advisor in the UK, Lee has worked in the Big Four accounting and advisory environment. He has also worked as an international tax advisor in two of the UK's largest businesses, BP and GSK, with an emphasis on advising and managing transfer pricing risk for operating units in those global businesses. Lee has particular experience in managing international tax projects, most recently in the Asia Pacific and South America regions. Over to you, Lee.
And thank you very much, Ed, and welcome everybody to today's seminar. So on the next slide, we'll see the agenda for today's discussion. So we're going to look at withholding taxes, some basics around the international setup and tax consequences and issues that need to be thought about when setting up overseas. The withholding taxes and their impact, their potential impact on corporates and how they might impact your financial modelling. An overview of some strategies to perhaps minimise those withholding taxes and other taxes, and strategies for profit repatriation. So on the next slide, we're looking at withholding taxes. So the first question is, what is a withholding tax? It can be something of a hidden tax that doesn't appear to people until such time as they want to move funds from one country to another, and suddenly they realise there's a withholding tax liability. It's not a corporate tax. A corporate tax is a tax on profit. I'm sure most people on this in this seminar would know. It's not a VAT or a GST or a customs duty. It's a withholding tax, and what does that mean? So it's typically a tax that's levied by a particular fiscal authority in its country on income that is sourced in their country. And typically it covers three types of payments, three types of income: dividends, interest and royalties. Why is it there? Well, it's a means for the fiscal authority to basically clip the ticket on an income stream before it leaves their country, so they can at least get their hands on some tax before any funds or any monies leave their country. So it's especially important where funds flow cross-border. So when does it apply? Well, it applies when there's any payments really made from a legal entity to another legal entity in a different country, whether they're related or not related. It can apply on any payments, although typically they are restricted to certain types of payments. And the ones that we typically see are applied to dividend payments, interest payments, and royalty payments. Increasingly, in quite a few countries, will charge withholding tax on technical services fees. And one of the complications that you can have in this area is a definition of what's the definition of royalties, what's the definition of technical services, and as we'll see later on, in more cases than not, if there's any doubt, the obligation to pay over the withholding tax falls on the entity that's actually paying over the sum of money in the first instance. So if there's any doubt, they will tend to take the least risky approach and automatically apply the withholding tax, which then leaves it to the payee, the person receiving the income, to actually then try and either get that tax back or get credit for it in the country in which the payment's received. Generally speaking, withholding tax does not apply to capital transactions, so the sale of an asset, sale of a company. That's not always the case, but it is a general rule of thumb. Potentially, again, one of the other issues that you may need to consider is what is a capital transaction for these purposes. You're dealing with a foreign tax jurisdiction, a tax authority. Their definition of a capital transaction may be different to what you think it may be, or different to the rules in your home country, and what you think may be a capital transaction may be an income transaction, and therefore there could be a withholding tax. So on to the next slide. In terms of dealing with withholding taxes, so the tax can be a provisional tax, so it may be a payment that's made on account of the final tax liability in the country, or it may be a final tax. So the withholding tax is deducted from the income source, and that's the end of the tax liability in that country. There's no more tax to pay. There are ways by which withholding taxes can be reduced or eliminated. Most countries around the world will have what they call a domestic system. So that's where they'll have domestic rates where withholding tax will automatically apply at the rate that they stipulate on the type of payment being made. So a dividend might attract a 20% withholding, interest might attract 20% withholding, royalties might attract 30%, technical service fees might attract 25%. But they may have entered into a double taxation agreement with countries. So the recipient of the income may be located in a country where there is a double tax agreement, and that may reduce or even eliminate the withholding tax. So you may find that the 20% on the dividends on an agreement between France and the US, for instance, may be reduced to 10%. It may be reduced to 0%. So there may not be any withholding tax.